Infinite banking sounds mysterious, like a secret system only wealthy people know. But the truth is less magical and more mechanical. At its core, infinite banking is a strategy built around a properly structured, dividend-paying whole life insurance policy. Here is the basic idea. Instead of relying only on bank accounts, credit cards, or outside lenders, you build cash value inside a policy, then borrow against that value when you need capital. Step 1. Buy a whole life policy designed for cash value growth, not just the biggest death benefit. That usually means higher early premiums and careful design, with the goal of building accessible cash value over time. Step 2. As premiums are paid, part funds insurance protection, part covers policy costs, and part builds guaranteed cash value. If the policy is from a mutual insurance company, it may receive dividends. Dividends are not guaranteed, but when paid, they can increase cash value, buy more insurance, or reduce premiums depending on the option selected. Step 3. Once cash value accumulates, the owner can request a policy loan. This is where banking comes in. You are not withdrawing cash value directly. You are borrowing from the insurer using the policy's cash value as collateral. That distinction matters. Cash value may continue to grow according to policy terms, while the loan balance accrues interest. Managed responsibly, loans can offer flexible access to money for major purchases, business needs, emergencies, or investment opportunities. Now, let's separate myth from truth. Myth. Infinite banking means you never need a bank again. Truth. You may still use banks, credit cards, mortgages, and investment accounts. It is a financing strategy, not a full replacement for the financial system. Myth. Policy loans are free money. Truth. Loans must be repaid or managed carefully. Interest is charged. If loans grow too large, they can reduce the death benefit, reduce available cash value, or cause a lapse. Myth. This is get rich quick. Truth. It requires time, discipline, consistent premiums, and enough cash flow to fund the policy properly. Early years may have lower liquidity because costs and design matter. Myth. Infinite banking works for everyone. Truth. It may fit people with stable income, long-term planning needs, and a desire for liquidity and insurance protection. It may not fit someone needing maximum short-term growth with inconsistent cash flow or who cannot comfortably commit to premiums. The realistic benefit is control. A pool of capital with fewer approval barriers than many traditional loans, while maintaining permanent life insurance protection. The trade-off is cost. Whole life can be expensive, complex, and slow to build value if designed poorly. Success depends on structure, funding, discipline, loan management, and long-term planning. So how does infinite banking actually work? You fund a specially designed whole life policy, it builds cash value, you borrow against that value, you repay loans on your own schedule while tracking interest and keeping the policy healthy. Over time, the same dollars may support protection, liquidity, and financing flexibility. It is not magic. It is not a loophole. It is a tool.